Hi everyone, welcome to another MPC Markets webinar series. Jonathan Takeyada with me here today.
Yes.
You recognise him from AusBiz. Now we're going to go through, given the recent Trump movements and uncertainty in the market, we're going to go through some portfolio protection. Something we haven't needed for basically 2 years, Jonathan, but you know.
Exactly right. So I think as we're recording this, the market's under 7,900. I'm talking about the XJO now, fallen from 8,600 down to 7,900. And it would have been nice to have protection then, but the thing is, we're seeing a lot of dangerous signs that this could actually keep going as well. So that's
Absolutely.
what we're here for.
So a good time to have a bit of a refresher about how to safeguard your portfolio. Now, the content presented in this webinar is general advice only. It's not for your specific circumstances. Please seek the advice of a professional before making any decisions. Past performance is not a reliable indicator of future performance, so I just thought I'd run through that first. We're going to make it quick. So what is risk? And I do like Charlie Munger's quote on this. Risk is what's left over when you thought you pretty much covered everything. No one really has everything covered. The likes of CBA this year, we've been made a mockery of, saying it's overvalued, and because the money flow in, but people get complacent. Is essentially
exactly, and I guess from a trading perspective, it's always the unknown unknowns that's what gets you out. So, but kind of like those black swan situations.
Well, yeah, everyone says, "What's the next black swan?" That's the whole point. You don't know. So. Now, and there's another one here, John Maynard Keynes, who is not only a world-famous economist back in the 20s, but also a mad stock punter. He absolutely was. He's one of the biggest traders leading into the Depression crash. And he just says, the market can remain irrational longer than you can remain sovereign. And that was something that I learned from my trading days.
Yeah.
You might be right, but can you go through the pain?
Exactly.
Is pretty much the point there. So the part of this risk management, part of the strategy with your portfolio is not just necessarily making the right decisions. It's getting yourself comfortable with what level of risk you've got on at the moment, and whether you're comfortable to give back profits or write these things down. So some of the strategies we're going to cover today to safeguard your portfolio in turbulent markets. Jonathan's going to cover how to hedge, mainly through the ETFs and a few other little strategies there. We'll have a more extensive one on that for those of you who like the more complex stuff in the options. Jonathan, our resident options expert, will probably do something in the next week or so. I think we'll both cover defensive sectors, and then portfolio reviews that probably may not do so many of them. And they are, the importance of planning, basically. Yeah. If you've got a plan in place beforehand, you always tend to react a lot smarter in the heat of the moment.
Exactly right. So if you've got it worked out, rather than trying to make decisions on the fly, where your emotions are really really heightened, then you'll probably make suboptimal decisions. So that's what we're here to try to avoid.
Well, yeah. I mean, yourself, 25 years in markets. Myself, nearly 30, and I've day traded for a living for many many years. Let me tell you, we've been through it before 100 times, so we understand your pain, and we're just more experienced at it, basically. So we can definitely help you navigate these situations. So, Jonathan?
Yep. So hedging is basically placing a trade that actually rises if the market falls. So what you can do is that if you have any cash left in the portfolio, you can actually just add one of these positions into the portfolio, and that'll partially hedge off. So the thing here is there's actually two versions. There's a bear, which is non-leveraged. So so for every 1% that the market drops, bear goes up. But if you want some actual leverage, you can actually have BBOS, BBUS, and SNAS, which actually go up 2.5 times versus that 1% fall. So basically,
we generally recommend these ones.
Yeah.
So instead of doing this and spending money on brokerage and using your capital, I mean, this is easy to explain, but you're better off doing 2.5 times less of one of these for the same value. So for those of you in the boats of owning CSL long term, CBA long term, those style of stocks, and you don't want to sell, these sorts of things are the definite beginner's guide, or beginner tools to be able to be neutral in your portfolio, but without realizing those capital gains.
And so the key as well is because there's leverage in these shorts, you don't have to deploy the same amount of capital to protect the whole portfolio as well. So you can easily just put maybe 10% into one of these. That protects the 20 to 30% downfall in the markets, which is historically where the markets tend to bottom out. So, we have seen falls greater than that. Obviously, back in
GFC and
that. But let's just say, just go historically, ever since the GFC, most pullbacks kind of limit, not limit, but once the markets fall about 10 to 15% or even 20%, that's when the dip buyers come back in. And so that's when you actually want to exit. But we're just saying, use a bit of leverage there, be smart about it, and
save yourself some money on commissions, etc.
Exactly.
And don't soak up all your capital. So that's just for general economic weakness, or if you want to take some profits. They're not like for like. So the ASX 200, will probably fall more than CBA, for instance. But so there is a little bit of tricky nature in it. These are not long-term positions.
Correct.
These are if you are in these positions longer than 3 months, you're not. It's not how they're meant to be used.
Exactly right. So we do remember that long term, stock markets do generate wealth and they generate value. So you don't want to be doing into these as investments. Basically, just protect yourself. Like during times of sort of volatility like this. Once the volatility is over, you just take them off and let the stock market do its thing.
Yeah. You got to remember about these indices. They kick out the underperforming stocks and they put in new ones that are performing.
They're designed
to go up.
Yeah.
So they're not long-term hold. Geopolitical worries, you want to be gravitating towards real assets. Some will say that gold is a hedge for the portfolio, just a blanket.
Yep.
That's not correct. The stats don't even remotely back that up.
Exactly right.
But in geopolitical situations, absolutely right.
But just in general, like if it's an actual liquidation event, gold gets sold off as well. But you're right, if it's more geopolitical, gold does tend to hold its value as well.
So, and you've obviously moved a little bit back to real assets. So now we're going to talk about which sectors are defensive. So, if you want to buy something or if you've already gone to cash or you want to take advantage of the dip, basically what we're going to say here, phase one expansion, your high growth companies. And I think this is pretty broad, but really IT, financials, consumer discretion, but really any growth company.
That's right.
Really
and don't forget, what's happened is, we've had that passive bid into the market. The money's just going to go somewhere, and it's all based on market cap. And what's happened over recent years is that basically money's flowing into IT, money's flowing into consumer discretionary, and it didn't matter if they were so expensive. Basically, the index just kept pumping money in. So what's happened now is that whole sector is so overvalued that it just doesn't make any fundamental sense. And when it does sell off, it can work in reverse. So
in the Australian market, IT and consumer discretionary really were more at the peak end of the market. This is probably more based around the US market. Energy and materials, I think, probably were a little bit further ahead here. That's just due to China, basically. So essentially what we've already seen the fall in energy and materials. We're starting to see the fall in financials. But where you want to be looking moving forward if you do want to buy something, healthcare. So we've always broken this down into really simple terms. Needs, not wants.
Yeah.
So you need healthcare, you need food, you need electricity. So they are the boring stocks. But the likes of your GrainCorps, your Elders, your Woolworths, in the utilities, APAs, one we've had recently, healthcare, CSLs at the bottom of the range, ResMed, etc. So they're the sorts of things that people are going to find the money to buy. Lavisa, maybe not. A new laptop, JB Hi-Fi, maybe not.
And then what you'll find is that these actually have been unloved all this time. So
they are very cheap.
They're all very cheap at the moment. So we're just saying that, hey, if you've had a great run, maybe take some of those profits and roll into something that isn't as expensive at the moment.
And you'll still get some yield, particularly. The agricultural stocks in particular don't pay their dividends for another couple of months. They report offset. So, there's some definite, and Woolworths is a historical low valuation. Obviously, this is US because real estate should just be outperforming in Australia, and the real estate doesn't go down, right? That's GDP growth and there's time. Now we're going to get on to portfolio review and planning. So we've got two methodologies here at MPC. We'll do a portfolio review, and we generally take into account just the single stocks and where they are, not where you entered, not where not how much you've got on.
Yeah, and don't forget, this is all general advice as well.
So exactly. So unfortunately, and then we can compare sectors out where we would be sector allocated versus where you're sector allocated. and we'll give you, ones to review, ones to sell, ones to hold, ones to switch to, etc. And then we'll make comparisons to yield, and those sorts of things. For those of you who have large positions or large holdings in one or two particular stocks, we do single stock risk management. So this one here is in WiseTech. We've also done them for Pro Medicus as well. But the WiseTech situation particularly was, we had this one was written April last year, so nearly a year ago.
Well, the thing is, you absolutely nailed it. Basically, all that came out afterwards, and you had it all documented well beforehand.
Yeah, so this little plan in here basically is the forward plan. And essentially, we didn't touch that stock until about November last year. And we managed to get everyone out in the high 120s. Today, trading $83. So, and look, it doesn't mean we won't look at it again. Promedica is the one that's still live and is still going very well. It's a very high PE, but we're concerned about it. But what we've done is trimmed along the way. And let me tell you, I would have sold the whole lot a million times in this rally. This thing's gone from $90 to $250.
Yeah, exactly.
So it and one of the richest, most expensive stocks, but they keep getting contracts. But when we set that plan in place making these decisions, we're not just selling random clips at a win. So
exactly right. Like you've thought about it when the market closed. You've actually put some levels in, and basically once it hits those levels, you just execute the plan.
Yeah, absolutely. And it's not you broke it. Your standard broker answer is going to be it's too big of a part of your portfolio. Well, if it's too big of a part of your portfolio because it's going up, I tend to think that's the silliest thing to sell.
Yeah.
So as long as you've set out a plan and you're managing it well, so we can do those we can do on request. These we can also do on request. But essentially, setting that plan means you're always going. And even setting a plan for buying back. Setting a shopping list so where you're buying stocks and towards the lows of the market when it starts to turn around. Don't just like randomly go in and buy any old stock.
Exactly right.
Have a list of the things you want to own for the next 3 years. So this is a bit of a bonus buy. We have some structured investments here. Jonathan, 20-odd plus years in options. Kai, who's actuarial background, myself in derivatives. We do structure up index products. So essentially we went to try and, have a better outcome than just a simple index ETF. And we came up with Index Pro. Do you want to...
Yeah, so a lot of times the whole ETF marketing is talking about that, managers can't actually beat the index.
On time in the market.
Exactly right. We've actually found something that will beat the index. And so this graph here just shows that, because we have a combination of fixed interest and leverage upside, if the market does rip and go on high, you'll actually outperform the index. But should the market fall, like we are in this situation, we'll still outperform because we have that portion of fixed interest in the actual structured product. So,
and a cap downside, some capital protection to the downside. So Jonathan's got a more detailed webinar on this, but the main points are you can't go any lower than down 15%, and you've got 1.3 leverage to the upside as well. So, and it's over a 5-year term. But in every situation, you're outperforming the index essentially. And when it's down here, you're not stressing out.
There's an actual limit to how much you can lose.
I've also got a fixed coupon. So obviously fixed income, very, very boring. We found a way to utilise baskets of stocks. So we've got downside barrier here, Ampol, Treasury Wine, Fortescue. This is the one we did last month. 40% downside barrier, which would basically place these stocks at net tangible assets, essentially. They're already been hit. 2 years, but we're getting 11.2% per annum. Coupons are paid quarterly. And essentially, do yourself a favour and have a look at those because at 11.2%, going back to cash, you're only going to get about 4.5 at absolute best.
Yeah, don't forget RBA's coming.
Exactly right. So to get a bit more of a comprehensive view of those, we've got another webinar. You can just make a request to the email here, which is either to David Sebesvi at npcmarkets.com.au or invest@npcmarkets.com.au. My number's there, 0402 303 044, or you can call Dave on 02 7208 8002 and just type in extension 800. If you'd like to see more webinars for MPC, we've done a couple recently on AI. We have a weekly podcast and podcast where we just generally chat markets. Obviously, we do a lot in conjunction with Ausbiz as well.
This is one I did with Kai on AI for Dummies. That one's actually quite popular.
And this one particularly was essentially saying, don't invest in the Mag 7, invest in the next wave. So some sage words from about a month ago.
Yeah.
So hopefully this has been really helpful for you. If you've got any questions, you've got the contact details there. Please don't hesitate to give us a call.